Hello everyone, welcome back to our channel and welcome back to this video. In this video, we wanted to share with you the Bank of Japan's rate decision and the global implications that this decision has for currencies as well as capital flows. The Bank of Japan raised its benchmark interest rates to 0.75%, the highest level since 1995. While the central bank moves in Tokyo might seem like a distant concern for global investors, this decision carries significant implications for currencies, capital flows, and the borrowing costs worldwide. For decades, Japan has maintained ultra-low interest rates, making the yen an attractive currency for investors to borrow cheaply and deploy capital into higher-yielding assets elsewhere. This strategy, known as carry trade, has quietly underpinned significant capital flows into American markets, European bonds, and the emerging market assets. The mechanics are straightforward. Borrow in yen at non-zero rates, convert into dollars or euros, and invest in assets offering higher returns. The spread between the Japanese rates and those elsewhere has made this a profitable strategy for hedge funds and institutional investors for years. Now, as the Japan's rates rise, several dynamics have come into play that extend well beyond Tokyo. Let's first discuss the yen strengthening and the carry trade unwinding. Now, higher domestic rates typically strengthen a currency as yield-seeking capital flows in. A stronger yen makes the carry trade less attractive, and in volatile conditions can force investors to unwind positions quickly. When leveraged positions are closed en masse, the resulting demand for yen can accelerate its appreciation, creating a feedback loop that destabilizes the markets. We saw a glimpse of this dynamic in summer of 2024 when weak US labor data triggered a sell-off that pressured leveraged yen positions, contributing to sharp moves across equity and the currency markets. Next, let's discuss the dollar as well as the euro vulnerability. The US dollar as well as euro face potential headwinds from two directions. First and foremost, the reduced carry trade activity means less structural demand for these currencies from the yen-funded investments. Secondly, and perhaps more consequential over time, Japanese institutional investors, that is the pension funds, the insurance companies, as well as retail savers who have long sought better returns abroad may gradually redirect capital back home as the domestic yields improve. Japan's institutional investors hold trillions of dollars in foreign assets, and even marginal relocation could meaningfully impact currency valuations. Thirdly, let's discuss about the emerging market currency pressures. Now, emerging market currencies which have benefited from yield-seeking capital flows may face particular vulnerability. Many emerging market assets were attractive destinations for carry trade capital, and a reversal of these flows could pressure the currencies from Brazilian currency to the Indonesian currency. Countries with current account deficits and reliance on foreign portfolio investment could experience heightened volatility. Finally, let's close with the bond market and the borrowing cost implications. Japanese investors are amongst the largest foreign holders of US treasuries. If the rising domestic yields prompt even gradual reversal, this could put upward pressure on treasury yields at a time when the US government faces substantial financing needs. Higher treasury yields ripple through mortgage rates, corporate borrowing costs, and sovereign debt servicing for governments worldwide that benchmark against the US rates. The Bank of Japan is expected to move cautiously, and short-term disruptions have historically been brief. And the governor of Bank of Japan has been careful to telegraph policy moves to minimize market disruption. However, if the Japanese rates continue climbing upwards towards 1 to 2% over the next few years, the cumulative effect on global capital flows, currency valuations, and borrowing costs could be substantial. In an interconnected financial system, the monetary policy decisions in one major economy rarely stay contained within its own borders. And the end of Japan's 3-decade experiment with ultra-low rates marks a structural shift that the global investors would be wise to monitor very closely. That's what we wanted to share with you in this brief video update. Stay tuned in for the next one.